Good morning to everyone. And today we will discuss the credit risk management part of your integrated risk management course. We have already discussed certain topics with regard to the credit risk management. Today also we just go on with the same topics, but with more comprehensive details. You will be able to just appreciate what you have learned at your normal day-to-day job situations or job challenges. When you have to face challenges in your job, invariably you will get the help from what you have learned. So that is the main intention of delivering this type of lectures. And in the process, you will understand the different aspects of credit risk management, and you might make use of those factors into your normal day-to-day operations, and you will get a more confident type of a stance with all these activities. And when your confidence built up, you will be able to achieve successful type of results from your job, and your career path will be really improved. Right. I just want to tell you something here. I think we had only 1 or 2 sessions earlier for credit risk management. For a country or for an economy, the most critical thing is the supply of credit. Even though it is critical, if it is not done correctly, the things can be out of shape in a very short time. Therefore, it is very much important for the people who are engaged in credit supply to deal with this credit supply in an efficient manner. Now, what do you mean by in an efficient manner? Because in any credit granting operation, there will be different types of uncertainties you need to face. With the uncertainties of that nature, in any credit process, you will have to face with severe challenges, severe risk. But if you are aware of those situations, and if you can project the things in a proper manner, then you will be able to get your things into a proper action plan, and you will be able to reap the benefits. Now, we just talked about how this credit risk is arising. Now, when you go into the reality, then you will find that many areas, many economic areas, many sectors will have a deficit in their funds. Now, when the deficit is there, in order to feed the economy, the supply of funds would be more important. But that supply, or we call it the allocation of credit, has to be done in a proper way. There you need to see whether the particular unit, the particular corporate entity, or the particular person or the counterparty would be in a position to absorb credit. And what is the quantity of credit he could, or the particular entity could absorb? Such things has to be taken into consideration. Right. Now I will just go through the things. I think we have already discussed about it, but I can just connect the things to the today's lessons with that. And I will go to that presentation now. Now we call it credit portfolio risk management. Now, even though we talk in terms of individual credits, we need to deal with number of credits in a particular portfolio. Now, the concept of portfolio comes with institutional setups. In an institutional setup, for instance, now say if you are in a branch, all the credit facilities granted can be taken into one portfolio. So then we call it branch credit portfolio. Now in that portfolio, you can have different sectors or different types of credits. Then sometimes you have residential or real estate portfolio. You might have vehicle loans portfolio. You might have corporate loans portfolio. Likewise, you can have different types of portfolios in that. Whatever the portfolio you refer to consists of several loans. Sometimes all the loans are in a homogeneous nature in such one portfolio. But in a branch, you can have different types of loans in different portfolios. Now, when you do the risk management or credit risk management in an entity level, that means the institutional level or a branch level, you need to consider the whole total portfolio. Basically, what we need to understand is when you take the portfolio, what would be the implications? Now, each of these loans will have sometimes a correlation. What do you mean by that? If you just look into a certain type of a loan in a portfolio, if that loan is going to be defaulted, sometimes there can be the loans of same nature. Those loans also would go into default. So that is what you call the correlation type of effect. So these are the most dangerous type of things in the portfolio. And at the same time, if you take a certain portfolio, say industrial credit. Now, if an industrial credit portfolio, if you get several loans as a particular valuation, now you can say if you have a total portfolio of 500 million and about 300 million loans were given to one type of industrial sector, so garments or whatever. So if that is the case, we call it a concentrated portfolio. And that is what you call the concentration risk. Now, when you go through this particular presentation, you will find different types of risk which can arise in a portfolio. When you talk in terms of credit risk in a loan portfolio, that is the measuring of credit risk in portfolio of loans. Now, if you take a particular portfolio, there can be inherent type of positive and negative correlations between assets. What is the meaning of that? Now, sometimes if one asset is going to be deteriorated in quality, other asset also can go into that situation. So that is what you call positive correlation. Because if something goes wrong with one asset, same way the other assets also will go bad. So that's a positive correlation. Or in other words, say if one asset is giving higher income or whatever, higher return, so if other assets also giving higher returns, then it is a positive correlation. But if you have a different type, so when one asset is go up in profits, when the other asset go down in profits, so that is what you call negative correlation. So if you take several type of activities and you have to find what type of a correlation is present between the two assets. But when you consider correlations, even though we take correlation into consideration in one portfolio, you need to take it into consideration two assets only, because the correlation really exists between two assets. But if you have 5 or 3 assets in a portfolio, how many correlations can be there? I'll say A, B, C. Now, when you have 3 assets called A, B, and C, can you say how many correlations can be present there? When you have only 3 assets in a portfolio. If you have only 2 assets in the portfolio, there will be only one correlation. Say, for example, if you have A and B, then the correlation is between A and B. That's all. Now, sometimes someone can say B and A, it is the same. So the correlation is between A and B when you have only 2 assets in the portfolio. Because when you talk in terms of a portfolio, at least you need to have 2 assets. Now I just ask you, when you have 3 assets in a portfolio, what will happen? How many correlations will be there? How many correlations? Now, this is a simple question. How many correlations will be there? Yes. How many correlations will be there? When you have 3 assets in a portfolio. Now, I am just going to put it in a very simple manner. Otherwise, people find it difficult to just get some idea about the portfolios. I want to just put it in a very simple way. That's what I am just asking this type of questions. Now, when you have 3 assets in a portfolio, how many correlations can arise in that portfolio?
3.
Yeah, there are 3. There are 3. Because now we take in terms of A, B, and C, then A and B have a correlation, B and C will have a correlation, and A and C will have another correlation. Then altogether there will be 3 correlations. Now, if you can get the trend and how it happens, you will be in a position to say that you will be in a position to just say how many correlations are there in that particular portfolio. Now, if I say there will be 4 assets, how many correlations then? There will be 4 assets. How many correlations would be there? When there are 4 assets. If you want, you can just draw it on somewhere and then get the answer, but you will find that there will be a certain type of formula for that. How many in the 4 asset portfolio? How many correlations? Then just for example, say A, B, C, and D. A, B, C, and D. And just see how many correlations would be there.
5.
Yes, you just look at it.
It's a 6.
Yeah.
Six correlations.
Yeah, there are 6 correlations. Yes, there are 6 correlations. So likewise, you will be in a position to. So in time to come, you will realize there will be a certain type of a formula for that. That formula also you will be in a position to, realize. And I think that's just a point I need to raise at this point. Now, when you take these correlations, now say for example, if you have 4 assets in a portfolio, as you say, now there will be 6 correlations. Out of these 6 correlations, 2 correlations can be negative, another 4 correlations can be positive. So likewise, there can be negative and positive correlations in a certain portfolio. So that is what the other thing you need to understand. Now, when you say concentration risk, now that risk is arising out of correlations. If you have several correlations in one side, or one-sided correlations, what do you mean by one-sided? Either positive or negative. Now, if you have such correlations, but when you talk in terms of positive correlations only, you will have an issue. Otherwise, the concentration can be really reduced. But if you have highly positive correlations in a portfolio, then it could be a concentrated portfolio. That concentration risk depends on the positive correlations. If you have more negative correlations in the portfolio, the concentration risk can be minimized. There can be several ways of measuring the portfolio risk. Number of ways or models to measure credit portfolio risk. And there can be several suggested mitigations, include diversification. Now, I think you have heard about this word diversification. The diversification is minimizing the concentration. The concentration is you might have some single type of exposure. That is what you mean by concentration. Now, I can give an example for that. I think you all have that idea. Now, in a portfolio, there can be exposures to only one borrower. Or we call it a name concentration. Now, in branches, you might come across such type of concentrated portfolios in several types. Any branch, if you go to any branch, most of the time, I'm just giving the general type of a branch. There you have a number 1 customer most of the time. That customer will have the highest exposure in your branch. For example, now some branches are there, their credit portfolio is, the total credit portfolio is about 400 million, say. Out of that 400 million, about 250 to 300 million is granted to one entity. So that is what you call name concentration. That is name concentration. Or I think you all have heard about these regulatory provisions for the banks to avoid such concentration, name concentration, and that's there's a regulation called single borrower limit. That single borrower limit is also a regulatory mechanism to safeguard the banks from concentration risk. And that concentration they are looking at is the name concentration. Now, in other words, sometimes if you grant substantial amount of credit to certain sector, then we have it as the sector concentration. We call it the sector concentration. Now, you talked about name concentration at the beginning. Then you might have sector concentration. The meaning is, if now say, for example, if you go to some area where the specialization is there, in Nigambu area, I think the most of the people are engaged in fisheries. then invariably the branch located in Nigambu area might have a portfolio concentrated on fisheries industry. So that's a possibility. If you take a branch in Moratuwa area, I think most of the credit, especially the industrial credit, even to furniture industry. So then invariably their portfolios are concentrated with furniture sector loans. So this is possible, and there can be specialties in different areas, and with that specialty, the bank also will have, their branches will have certain concentrations. Now, in order to deal with such concentrations or to mitigate the concentration risk, there can be several suggestions. But these suggestions are not limited to diversification. There can be several other suggestions to deal with this type of concentration. Now, when you talk in terms of concentration risk, it is a major part of the credit portfolio risk. Now, if you talk in terms of a portfolio, the major part of portfolio risk is taken as the concentration risk. Now, the second sentence, it gives a certain indication about how this concentration is arising due to uneven distribution of bank loans to individual borrowers. Uneven distribution. Uneven means some types of borrowers being given some preference or some bias. That is what you mean by uneven distribution. Sometimes unevenly distributed to certain industries or certain geographical regions. Now I am asking a pertinent question now. In terms of geographical regions, do you think the banks have a concentration? I am asking a very general question. In their, especially in their credit portfolios, if you take a bank, do they have a geographical type of a concentration, a geographical region type of a concentration? What do you say? What is your idea about it?
Yes, they have concentration with geographical.
Yeah. What is I mean, in Sri Lankan situation, what is that?
If some places that agriculture sector is more concentration for that, if it's when some places they have mainly for rice agriculture sector like that.
That concentration is there. No, I am just asking the geographical concentration. Now that is, now when you talk in terms of geographical regions, then the concentration is taken into consideration the geography or the particular region. Now what I am asking is, the banks are vulnerable to such type of geographical region concentrations. So what is that in Sri Lanka, basically? Now, most of the banks, if you take any bank, their loans, most of the loans were given to one area, like, that is the concentration. Now, in Sri Lanka, Western province, I think even the branches are concentrated in Western province. Loans are concentrated in Western province most of the time. I don't know whether you agree with me. If you have any ideas opposing that, you can just put forward those ideas. My idea, I'm just telling you, because I think there was a problem like that. Now I think there are certain type of mitigations being taken into consideration now, but it has been there for a long time. Now in any bank, if you take the loan concentration, say for example, now in Sri Lanka, we have provinces. Out of these provinces, highly concentrated loans, I mean, if you take the provinces, all the provinces, there's no even distribution among the provinces. One or two provinces will have uneven type of a distribution, especially the Western province. Every bank is concentrated in Western province, in geographical region type. So that is what I want to ask you. But as you say now this agricultural sector, then now in the agricultural sector also there can be several agricultural type of things, paddy, tea, rubber and coconut type of things or whatever. So those things will be there. So that is those things are called sector concentration. When you say geographical concentration, that is the geographical area-wise concentration. That is what I want to tell you. Anyway, I think you get my point, where even in Sri Lankan situation, not only in Sri Lanka, in other countries also, there can be several geographical region concentrations. And not only that, there can be concentration on instruments also. Instruments in the sense, in some banks, you can see if you take the loans, the security of loans, if you take the most of the loans are given on real estate security or mortgages. Then that is another concentration. So we call it instrumental concentration or security concentration. Any question you can raise if you are not really got it in a particular way, so you can just raise any question now.
So it's basically concentrated towards the capital of the country.
Yeah, basically yes. Just Colombo areas. That is why the Western province is really vulnerable for that. Because Western province is the particular province which the capital is located now. Yeah. So therefore it happens that way. Even in other countries, it is the same. Now in India, the Mumbai area or Madhya Pradesh, that is the most concentrated area for banking and all. That happens in any country. But the thing is now, the economic policy formulators and central banks, and they try their best to mitigate these concentrations, because they want to just provide facilities to all provinces, provide banking facilities, provide lending facilities to all provinces. So by doing that, this concentration can be mitigated. So that is what the governments are looking for. But it is not that easy. It's a challenging operation. But if you take the banking institutions, managing concentration is especially important for small and medium-sized banks. They lack diversification tools or have deliberately concentrated lending to exploit expertise in certain industries. Now you can see, now this is the particular thing what Sri Lankan banks are faced with now. Because since they are not that big sized, so medium sized banks actually they face with this particular problem, because they lack diversification tools. Not only that, they really specialize in certain small and medium size type of industries, and they lend to concentrated lending to exploit expertise in certain industries. So that is a normal trend in Sri Lanka. Now you have seen in some banks, they just do lending to micro industries, the smaller banks, the micro industries, but there's a concentration. They have given loans only to the micro type industries. So that is another issue. They concentrated on that. Now the last one, the loan concentrations. Now it gives some idea about the measure of a loan concentration. In general, loans in some specific economic categories or types, commercial real estate, in excess of 100% of capital funds would constitute concentration. Now that is what it means. Now I can just give you a certain type of quantification for this concentration. I will just explain it on the board. If you feel that you are not getting it, just let me know. Now I will show you now. Methods of quantifying concentration. Methods of quantifying concentration. Now, one method is given in the presentation, and it says if the entity granted advances to a certain sector exceeding 100% of its capital, it can be considered as a concentration. Can be considered as a concentration. What does that mean? What does that mean? What does that mean? Now, for example, say we are talking about the bank ABC Bank. The capital is say 1,000 million. 1,000 million is its capital. Now, what do you mean by 100% of capital? 1,000 million. In a portfolio, if you have granted loans to a particular sector, the total amount of loans in that sector exceeds 1,000 million, then we call it a sector concentration. You got my point? So that is a way of looking at concentration, and it's a type of a quantification. If it is for a sector like. Now, for example, say a bank, its capital base is say 10 billion. 10 billion, right? 10 billion is 10,000 million. 10,000 million. But they have granted loans more than say 100 billion loans being granted. Okay? 100 billion loans being granted. But out of that 100 billion, say, they found a particular sector. For a particular sector, out of that 100 billion, they have 20 billion of a granted to a particular sector. Now, do you think, would it be a concentration for that sector? Would it be a concentration for that sector? Now, we will go by this principle. Shall I come back? Now, it's like this. I told you the bank has a 10,000 million of capital. So that is 10 billion of capital. They have granted advances. Total loan portfolio is 100 billion. 100 billion, right? That is the total portfolio. Everything is taken into consideration. Altogether, it is 100 billion. 100 billion. This is the loan portfolio. Loan portfolio. Capital is 10 billion. Now the particular bank has found that they have granted, in total, they have granted 20 billion loans in total to the apparel sector, apparel industry. 20 billion loans to apparel industry. Now my question is whether that bank has a sector concentration to apparel industry. Yes or no? You have to go by the principle.
Yes.
Yeah.
Yes, there is a sector risk is there because they are funded about their capital to the particular one industry.
Yeah, right. I think you got the point. Now, since the loan portfolio is 100 billion and out of that 20 billion loans granted to in total apparel industry, but its capital is 10 billion. If some entity granted loans 100%, more than 100% of their capital to one sector, then it could be a sector concentration. So in the same lines, now the limitation is 10 billion loans for one sector because its capital is 10 billion. But this particular bank granted 20 billion to one sector. So therefore, it's a severe concentration because it's double the amount. It's double the amount. So therefore, it's a severe concentration. So I think you got my point. So that is only one idea. There can be several other ways of doing that. Now I think you know that there's a regulation. Single borrower limit. Have you heard about it? Now what is that? Any single entity cannot get a total of loans exceeding 30% of the capital base, the bank's capital base. Now, if you take this bank, what is the capital base? 10 billion. I told you 10 billion. No, capital base is 10 billion. $10 billion. Now, single borrower regulation. There's a regulation in Sri Lanka also. So what is that regulation? It says one entity cannot get a total of loans exceeding 30% of capital. So that means what is the maximum total of loans could be granted to one entity if the capital is 10 billion. Only 30% of capital, no? So that is 3 billion. No bank can grant to a one entity exceeding the 30% of their capital, bank's capital. So that is what you call the single borrower limit. But if that entity is a group of companies or whatever, then it can be exceeded to 33 and 1/3%. So these are the types of quantification of concentration. I think you got my point. Because I try my best to put these things in very simple terms. Otherwise, you would not really, you might discourage yourself by looking at these very complicated type of things. I just want to put these things in very simple manner, simple terms. Have you got that now? Now you got some idea about it. Now, when you talk in terms of sectors or whatever, the limitation is 100% of capital. But if you go by the names or single borrowers type, not sectors, no, single borrowers, then it should be less than 30% of capital. So these are a type of limitations or limits. that gives you a certain idea about concentration. It's a type of quantification of concentration. Anything you need to clarify on that? Anything you need to clarify on that?
If
Yeah.
if we consider the group exposure, different entities, what is the percentage?
Yeah. If you consider group exposure totally, so that should be less than 33 and 1/3%.
Okay.
33 and 1/3%. That is 1/3. 1/3 of a capital.
Okay. Thank you.
1/3 of a capital. Yes.
So
There's a small increase. There's a small limit increase for that. Increase the group.
So is it this tier 1 capital or the total capital?
Total capital. We call it the capital base, right? We call it the capital base. Capital base, now say, sometimes the debentures and all should not be taken in that case. Not the tier 1, right? Now tier 1 is highly qualitative capital, no, but anyway, we call it the capital base. But the long-term lending type of things or long-term borrowings cannot be taken into consideration, but other things to be taken into consideration. I think there need not be any type of a confusion, because there's no there's no confusion there. We call it, the term is given as capital base. Capital base. Now the capital base can be tier 1 or tier 2, all together. Now that is why some of the banks, they try to give high volume loans, but they can't give it a loan. They give syndicate loans for such type of organization. Now say, for example, the Road Development Authority, now they need a loan, say they need a loan of say 20 billion. Banks cannot really grant that loan because it really exceeds their limits. So then what will happen? Then 3 or 4 banks get together and give that loan. So one bank gives 4 billion, the other bank gives 5 billion. Likewise, they just give that way. And then it would be a syndicated loan. Right. Now we can go again to the presentation. Right. Now, concentration risk is arising not only in credit, it can arise in market risk, liquidity risk, operational risk also. Now we can see how it comes. Under credit risk, it can be single name concentration that we now talked about. We discuss about it now. Single borrower limits are being imposed to avoid these single name concentrations. Then as we discussed the industry concentration, then there can be supply chain concentrations also. What is that? Can anyone give any argument on this supply chain concentration? What is that? I think it's a very interesting point, supply chain concentration.
Depending on the one company, for example, taking IT facilities, for example, taking data only for the telecom.
Yeah. So then how can you explain that supply chain concentration?
So totally, if we are depending on the telecom, if something happened to telecom, their lines, then all our
no, I mean
bank.
I think you are now referring to operational risk, but now here it is our consideration is the credit risk. So supply chain concentration in credit risk. Now we have to talk on that terms. So what is that? I think you are trying to say something, but it is really not connected to the credit risk. That is the issue. So how can it be connected to the credit risk? That is what I am asking.
One industry is having a connection with another industry.
Yeah.
If the one industry has affected, it will have an impact on other industry, which that is also borrow from the banks. They have a connection between both industries.
Yeah, that makes some sense. Yes, that makes some sense. It is like this. Now say supply chain means, now in the supply chain there can be several stages, no? Raw materials are there, and then labor is there, all these things are there. So when you say supply chain concentration, now you have granted credit only to a certain type of, say you have granted credit to all the raw material suppliers or whatever. So that's a supply chain type of a concentration. So then if something goes wrong with this raw material suppliers, then you will have an issue. So that is what I mean by supply chain concentration. You got my point. Now in the supply chain, you have several things. No, you have raw material suppliers. That is supply chain, raw materials, labor, other peripherals. All these things will come that way. So then if a bank has granted credit to a particular supply chain factor concentrated there, so that is an issue, no? That is the issue, what you call supply chain concentration. Is that okay? You got my point? Have you understood that? Now you try to say that. Yes. Now you all know the meaning. What is the meaning of supply chain? Supply chain is now for several industries, you have supplies, the raw materials, labor, other ingredients and all. So those are what you call the supply chain. Now I think in this COVID incidents also, there have been several issues in the supply chain. It is not a concentration. Supply chain issues were there. What do you mean by supply chain issues? The supply of several things. Now, even this COVAX, this AstraZeneca vaccination, that also had the same issue. They had the supply chain issue. Supply chain issue means the supplements, supplies. They didn't get it. That is why they couldn't manufacture the AstraZeneca vaccines in time. So then supply chain issues mean issues in the supply chain. Supply chain concentration is you have granted advances to particular area in supply chain, either raw materials or labor, whatever it is. That is what you mean by supply chain concentration. Anything else you need to talk? Yes. If you have any idea, just we can exchange that idea. No issue. Yes, I think if you have any query or any problem, you can just in call messages you can put a message even, no issue. So we can just proceed. Huh? Right. If you take market risk, there also you can find concentration in currencies. Liquidity risk also concentration of finance sources. financing sources. Operational risk, you have concentration of vendors. That I think that's what some person tried to say, that telecommunication or whatever. So that actually this operational risk, concentration of vendors like, right. Now in portfolio risk management, if the banks are engaged in portfolio risk management, regulators examine when they want to see whether the portfolio risk is managed properly, then they have to go through this type of things. Concentration management. Now the concentration management is really going through these single borrower limits, sector limits, and all sort of things. That is what you mean by concentration management. Then the next is exposure to sensitive sectors such as commercial real estate, stock market, commodities, etc. Now, what is the meaning of that? Exposure to sensitive sectors such as commercial real estate, stock market, and commodities. Now, for example, if a bank is highly exposed to the commercial real estate sector, that could be an issue. That could be an issue. Why? How we can say it could become an issue? Commercial real estate. Yes, you can just come up with your ideas. Why do we say these commercial real estate, stock market, and all that type of things are sensitive sectors? Why do we say that?
Because prices are fluctuating very frequently.
Yeah, very frequently, and especially the commercial real estate, because the commercial real estate actually it's a very illiquid type of a market. Commercial real estate market is a illiquid market. Illiquid means you are buying and selling type of a thing. There will be a very big gap between the purchase price and the selling price. Then in such a situation, we call it an illiquid market. Illiquid market. So then it can pose several issues, the commercial real estate. I can just give an example. I think nowadays there's a particular trend that people try to sell their properties, especially the suburbs. In suburbs, people try to sell their properties. I don't know what is the reason, but nowadays there's a big, most of the people, they try to sell their properties and then they try to just get some apartment or whatever from Colombo or some closer place, and rather than keeping their properties. Those are all those properties are in the suburbs. They want to just sell those properties. Now, what would happen if that particular trend continues? Just tell me something about it now. That's a very interesting point to note. Now, this normally happens with commercial real estate. Now, can anyone just explain what would happen if the trend continues?
There will a price increase for the apartments in the near future.
Yes, right. There could be. That is one possibility. But now say, if people try to sell their properties and many people come to the market to sell their properties, the meaning is you will have a high supply of commercial real estate in the market. That would invariably bring down the price, no? Price of commercial real estate will come down, basically. That will happen. So then what is the result of that? Even the loans granted on commercial real estate will become bad. Why? The property owners might think that their properties are not high in value now. It is better to keep the property with the bank rather than getting back. You got my point? So that is what happened in the economic crisis in 2008.
So now that is happening to the vehicle market nowadays, sir.
Of course, yes.
Because the prices are going very drastically high because of the importation. And
vehicle market is but only thing is now, since it is going up, but now in Sri Lanka, what happens is now the imports are really banned now, no, because of that that price has gone that way. But now even though it goes as high as that, there can be, now we call it a bubble. We call it a bubble. So, but in real estate, basically, what will happen is now, so when the people try to sell their properties, and there will be a high supply of properties to the market, even though they ask for a higher price, they would not be in a position to sell those properties at that price. With the supply of so much of real estate to the market, what would happen? The price will drastically come down. And it will affect the loans granted on the mortgages of commercial real estate or whatever. And those loans will have a big issue. Can you guess that? What would happen? Now, if the real estate properties values go down, what will happen? Now, on the basis of the values only, the loans were granted, no? And the property value, if it goes down, it might go down below the loan value also sometimes. Then the particular person who borrowed from the bank, he would not have any incentive to pay back the loan, because he would kept the property with the bank without taking it back. You get my point? So that is the danger. So therefore, now as you say, another reason is now, as you say, the price fluctuations are so much in stock market and commodities even. That is why we call them sensitive sectors. Commercial real estate also the same, because there can be price fluctuations, but the danger is very much higher than stock market and the commodities, the commercial real estate, because it has a low liquidity, and that's another case. Right. I think now you can just get that in guess, like, in commercial real estate, what would happen. Even now out of these 4 methodologies, the stress testing is another very important point to note. Stress testing. You all know what is stress testing, no? Now, you just make a hypothetical stress to the portfolio and see what would happen as a result. So what would happen, or how would it be affecting the capital adequacy? How it would affect the liquidity? How would it affect the profitability? And all those things will be tested through stress testing. And the portfolios to be managed after getting this stress testing done, because then we would be in a position to see, in a stress scenario, what would happen. And if that happens, what would we do to deal with such situations? So that is what you mean by stress testing. So that is a part of regulators' examinations on these portfolios. Then the last one would be independent oversight. What is that? Now, independent oversight is done by whom? The central bank or the regulators. They just look at the things in an independent point of view. There's another technique here. We call it the Herfindel Hirschmann index. It is sum of squares of relative portfolio shares of all borrowers. Well-diversified portfolio with large number of very small borrowers has HHI value close to 0. Heavily concentrated portfolio has high HHI value. We call it HHI index. HHI may also be calculated for groups of borrowers or industry. That is also another possibility. Now, if you have several industries in a portfolio, so you can have HHIs calculated depending on the industry also. I will show you how to do the calculations. This is a measure of concentration risk. And I will show you how to do it. Right. Now, just consider about this portfolio. There are only 10 loans here. I have given the values of the loans, 200, 100, now in millions, right? Yes. $200, 100, 150, 50, 1,500, 200, 100, 200, 100, 150. Now, all together, the value is 2,750 million. Now, I will show you how can we calculate the HHI, Herfindel Hirschmann index. Now, when you calculate that, now this is the way. First of all, we have to get the contribution of each loan here. So, how do you get it? 200 divided by 2,750. So, you get the point here, right? So, I will just calculate it for you. $200 divided by 2,750. That is, you can say 0.073. So we will get it for to 3 decimals. 0.073. 0.073. Then next one is 100 divided by 2,750. That is 0.036. 0.036. Then 150 divided by 2750. That is 0.055. 0.055. Then 50 divided by 2750. 0.018. 0.018. Then the next one, 1500 divided by 2750. That is 0.545. 0.545. Then 200, again we have to, same thing is there, so it's 0.7073, 100, 0.036, 200 again 0.7073, 0.036, and 50, 0.055. Right, now you have, I just put the contribution of each loan here. 0.073, 0.06. Now, if you take the total, it should be 1. Total should be 1. But when you want to calculate the HHI, what we should do? We should get the squares of these contributions added up as a square. What is the square of this? That comes to 0.005. 0.005. And you get 0.0011. 0.001. Then 0.055. 0.003. Then 0.018 square, 0.0003, 000 cents. Then 0.545, that is when you square it, you get 0.297. And if you take 0.073 again, the square would be 0.005. 0.001. 0.005. 0.001. 0.003. Now what we need to do is we need to get the total of it. I will get the total for you. Now you get the value 0.3213. This is the HHI. This is the HHI for this 0.3213. Now, this is a measure of concentration risk. Now, if you take this value, if the portfolio is not concentrated, you should get a value which is very close to 0. But we can't say this is close to 0. 0.32 is a bigger amount. Now, if it is more than 0.001, it is substantially concentrated. Now, this is a highly concentrated one since it is the value is 0.32. But there's no such rule to say that this should be the level of concentration. But what we can say is, if you get a value which is close to 0, then there's no concentration in the portfolio. If the value is higher than 0 in the sense, it should be say more than 0.09 or something, or more than 0.08. Sorry, more than 0.05, right? If it is more than 0.05, then it's a, now depending on the value, there will be a concentration. But if you get a value of 0.3213, so it's a highly concentrated portfolio. Now, even if you look at it, you can see it has a highly concentrated portfolio because you have one loan 1,500. The total portfolio is only 2,750. So then one loan has a contribution of more than 50%. So that is the high concentration. Anyway, you have any questions on that? Questions on calculation? Yes. This is a very famous type of an index. We call it Herfindel Hirschmann index. Herfindel Hirschmann index. Is that clear, the calculation? Yes. If you have any issue, let me know. Yes, Abodhini?
No, sir, but this presentation is uploaded.
This presentation not uploaded?
Yes, sir.
Oh. Anyway, but I have just asked them to do it. Anyway, I send these things little earlier even.
Okay.
Anyway, it's okay. I mean,
okay.
I will.
Okay, sir.
No, can you just follow these things?
Yeah. Yes.
Right. Okay. And what I want to tell you is now there's no rule to say that this should be the demarcation for concentration and non-concentration. So that is why I can't say anything. But what I can tell here is only that if HHI figure is close to 0, then only we can say the portfolio is not concentrated portfolio. If you have a value which is higher than 0, then it is a concentrated portfolio. Now that degree of concentration to be measured on the basis of the index. Now 0.32 is a very high concentration number. Now, do you have any issues on that numbering? Because it is now, for example, say if you want to see, I mean, if you want to compare the degree of concentration of two portfolios, This is a very good way of doing it. For example, say, I have 2 portfolios in my bank, right? I have one portfolio, it's a real estate portfolio, commercial real estate portfolio is there. Then I have another portfolio, vehicle loans, right? I want to see what is the portfolio with higher concentration. What should I do? What should I do? I have 2 portfolios, right? I have 2 portfolios. One is a portfolio of commercial real estate. The other is the portfolio of vehicles, vehicle loans. Now I need to see what is the portfolio with higher concentration. What should I do? What should I do? Yes.
Calculate the HHI for both segments and see what's the largest figure. The
higher figure. Higher figure indicates the higher concentration. Higher the figure, the higher the concentration. That is what.
But sir, this is only 2 portfolios in the book, so the percentage also will be in terms we can understand, no sir? Which is
of course, yes.
Only two portfolios are there. If it is number of portfolios, this index will be all right, no sir?
No, it's like this. Now say I have taken for simplicity, I have taken only 10 loans in the portfolio, and it is not that difficult. But if you have a portfolio of 100 loans, then it is little difficult, no? I mean, you have to do the calculation, no? But in an Excel sheet, you can do that, no issue. But this HHI gives you a certain indication. That is what I want to tell you. As you say, now what we need to do is we need to see the degree of concentration by looking at the number. If the number is high, higher the concentration. If the number is low, lower the concentration. So therefore, in my question, I ask you, I have 2 portfolios, and how are we going to look at the portfolio which is with higher concentration? So then, as you say, we have to get the HHI calculated for the both portfolios and compare it and see whether what is the higher number. So higher number, the portfolio with that higher number could be the higher concentration portfolio. That is how we can answer that question. Anyway, that is very simple. That is very simple. And I like to just have your contributions also here, because if you don't talk, then I might say, I might have to get the idea that you all understood everything, but it is not the case now. So therefore, you can come up with your own issues and own confusions or whatever. Then only we can sort it out. Otherwise, it is difficult for us to sort out anything. And in time to come also, then you might have a backlog of certain things, and it will come as a big burden for you. So therefore, you can just clear it up then and there. I think that is the most important thing. And you now say, as you think, these are not that difficult, right? Now that's only I want to tell you. So I try my best to just put it in very simple terms. With that, if you want to talk, that is, I really appreciate, or I really welcome all of you to have a discussion. Now, this can be done for several industries also. And there's another measure to do the concentration index, or whatever we call it, a concentration index. Gini coefficient. It's a measure of deviation of a distribution of exposure amounts from an even distribution. So it's a type of a comparison we make. GC close to 0 signifies homogeneous portfolio. I will show you what it is. GC close to 1 indicates highly concentrated portfolio. Now, they are also the same type of a methodology, but it has a little difference and it's a graphical thing. Right? You can just look at it. Now, we call it Lorenz curve. Now, just look at it. Now, this is it's a graph drawn with regard to two axes. Now, this is the horizontal axis. It signifies the proportion of borrowers. Proportion of borrowers. And the vertical axis signifies the proportion of exposure. So, what does that mean? The real meaning here is %10 of borrowers, how much they contribute in exposure. 20% of borrowers, how much they contribute in exposure. 30% of borrowers, now it's a cumulative type of a thing. And now when you go into, along that x-axis, now in the first place you have 0.10. That is the proportion of borrowers. Now 0.10 means 10%. 10% of borrowers, if you take, first 10% of borrowers contributes. Now, if you look at the dotted line is the curve you plotted. So there you have, now when you have this 0.10, if you just look at it, the value, corresponding value would be 0.06. That could be the corresponding value in the y-axis. So that means 10% of borrowers represents only 6% of exposure. That is what it means. Have you got it? This is just a plot. Now you have the number of borrowers and their exposures. Then you have a data sheet where you get the value for the first 10% of borrowers. Now, first 10% of borrowers contributes only 6% of value. And when you go to 20% of borrowers, they represent how much value? About 12% of value. 30% of borrowers represent about 18% or 19% of value. 40% of borrowers represent 25% of value. So likewise it goes. Now 100% of borrowers contributes 100% of value. That is okay. And now when you say 90%, you go to 90%, 90% represents how much? About 70% of value. That is what it means. You got this understood? Yes. Come up with your ideas. You can see the points here, no? This is a very important type of explanation or demonstration. Yes. What do you say? Now again, you can just look at the two axes. X-axis represent the proportion of borrowers. 10%, 20%, 30%, 40%, 50%, 60%, 70%, likewise. That is the number of borrowers. but the vertical axis represents the value of loans, right? Now, when you just go through the diagonal represents the even distribution. Diagonal represents the even distribution. What do you mean by even? There you get 20% of borrowers represent 20% of value. 30% of borrowers represent 30% of value. So likewise, now you have a very even distribution there. But in reality, what happens is 10% of borrowers represents only 6% of value. 20% of borrowers represents about 12 to 13% of value. Likewise, you can just see. Is that okay? Right. Now, this curve is known as the Lorenz curve. Lorenz curve. Right. Now, you just look at these things. Now, the Gini coefficient is calculated by dividing F. F is this area. This area. It is F. To be divided by F plus L. F plus L is the triangle, this triangle. It's a rectangular triangle. Here. F plus L is that. Now F over F plus L. Now you can just see the Gini coefficient will become a higher one with F becoming higher. So there can be another situation that this particular curve can come like this, no? If it comes like that, F would be higher. So if F would be higher, then the GC would be higher. So likewise, now if you say, if this curve comes very close to this diagonal, then your F value is very low. Then your Gini coefficient would be low. Have you got that point? Yes. What do you say? Do you understand what it is?
Is this graph is telling that if it's some borrowers is having high portfolio, if that it's trying to?
Yeah. That is the case. Now
Okay.
just look at it. Now, when you say proportion of borrowers, right? Now here, first 10% of borrowers only represents 6% of value. No, you can just check it. No, now if you do this way, I mean, now if you draw a line, a vertical line from this point to the curve, right? And then you have to have another parallel line from that particular point to the y-axis, and it meets y-axis somewhere in 0.07 or somewhere, no? 0.07. So that means 10% of borrowers represent 7% of value. 10% of borrowers represent 7% of value. When you go to 20% of borrowers, they represent about 12% of value. When you go to 30%, they represent about 19% of value. So likewise, but what I want to tell you is, if something uneven distribution is there, what will happen? Now, if the distribution is even, what will happen is 10% of borrowers should represent 10% of value. 20% of borrowers should represent 20% of value. So that is the ideal situation. But it won't happen, no. In a real portfolio, it would not happen. But in an ideal situation, if it is distributed evenly, what will happen is a percentage of borrowers will be equal to the percentage of proportion of loans, the portfolio values. If that is the case, it is evenly distributed. But if it is not happening, then percentage of borrowers will not be equal to the percentage of proportion, value proportion. Now, it is happening in, as per this curve, it is happening. So then if you go to any type of proportion, now I just explained 50% of borrowers. Now see, what is the proportion they represent in the value? Now you do a line like this. You have to draw a vertical line from 0.50 and it meets the curve at this point, and you can demarcate that, or you can just put the point there, draw the point there, and from that point you need to draw a parallel line to the x-axis, and that parallel line meets the y-axis at by say 32.32. So that means 50% of borrowers only represent 32% of value. 32% of value. That is what it means. Right. Now the background or the real principle we want to explain here is, we go by the areas of these curves and all. Now the area surrounded by the diagonal and the dotted line is called F. The area surrounded by the dotted line and the two sides of the two sides in the sense that there's a square here. The square, you have two lines or two sides. Those two sides and the dotted line, that creates the area called L. So how do you calculate the Gini coefficient? You have to find the area of F, and it is to be divided by the area of the triangle. There's no measurement device for this, but if you can do it through a graphical way, you can do it. On a graph, you can do it, but otherwise we don't have a methodology to calculate this area. But anyway, you can get the area of this particular triangle. So that is the denominator, but numerator is the area of F. Now here the principle is, if this curve, the dotted line, come close to the diagonal, what will happen? Gini coefficient, what will happen to the Gini coefficient? Because this is a real situation now represented in the graph. Now, if that real situation, if you have a graph, that graph is very close to the diagonal. If that is the case, what would happen to the Gini coefficient? Would it be lower or would it be higher?
Lower.
Would be lower. Yeah, it would be lower. If this particular dotted line comes close to the diagonal, the area of F would be lower. So therefore, Gini coefficient would be lower. So that means closer the curve to the diagonal, lower the concentration of the portfolio. Closer the dotted line or dotted curve to the diagonal, lower the Gini coefficient or lower the concentration. I mean, if it is in more distant from the diagonal, the dotted line, then the higher the Gini coefficient, higher the area of F. So higher the Gini coefficient and higher the concentration. Right? Now I will show you some graphs on in the board, right? So then you can get some idea. I just look at these graphs. Right. You can see the diagrams on the board. Right. Now, what you need to do now is these diagrams, these graphs are being done on 3 portfolios. Now, I have put it as 1, 2, and 3. 1, 2, and 3. 1, 2, 3. Now, what you need to do is you need to put these 3 portfolios in ascending order on concentration. That means you have to put the first one, when you say ascending, it is going from the lower one to higher one. You have to give the ranks, I mean, give the ascending order of these portfolios. So first you have to get the what is the lowest concentration. Then you get the second concentration and the third concentration. So that way you have to put the numbers. Just do it. What have you understood the question? Now, by looking at these 3 graphs, you have to put the numbers in an ascending order on account of its concentration. Ascending order, right? Ascending order means from lower one to higher one. From lower one to higher one. Just do the numbering. Yeah.
3, 1, 2.
3, 1, 2. Yes, correct. 3, 1, 2. Yes, correct. So now I think you get my point. So it's a very simple thing. So if you want to compare the concentration of 2 or 3 portfolios, you can do this type of graphs and do the comparison. And the comparison, and if you are not really satisfied with the comparison, what you need to do is now, then later on you can do the HHI calculation also, then you can get some quantification for the concentration. So these are the things which you can understand with regard to the concentration risk. So I think any questions on that? Anything else to be clarified? And you have to be careful about what we talk in terms of these x-axis and the y-axis. X-axis represents the percentage of borrowers, the number of borrowers. The y-axis represents the percentage of volume of loans, percentage of exposure. That is what we need to understand when you look at these things. Yes. Anything you need to clarify? Now, do you think that these things could be helpful in your credit risk management and credit analysis? Because we are now talking about the portfolios, not the individual loans.
Yes, sir. We can, at a glance, we can come to a conclusion.
Yeah,
We have to focus more on.
Yeah. So these are the things which you need to apply, because it is not necessary to go for very complicated type of things. And use these simple techniques for your day-to-day decision-making situations. And I think some of you might engage in some credit committee meetings and all. No, sometimes I don't know whether you are in that category anyway. But in time to come, you need to do that. No. So when you go to a credit committee, then there can be several discussions going on. So what we need to do is we need to contribute something towards such meetings and all, and then you can be a good decision maker. Risk management is a thing where you can really grasp the things in a proper way, and then you will become a very confident person and a very confident type of a manager, and you can really convince the others by giving your ideas. So that is what we need to inculcate. And you can have a very good mindset and very good decision making power with all this knowledge. What we need to do is we need to have a particular sense developed to see that what would happen in the future. Like, we can't do it 100% correct, but we should be in a position to at least to just get the trend identified. So that is enough for you. You can't do everything 100% correctly calculated or whatever, 100% correctly projected. But it is not the way. But you can, at least you can just think about the trend, what could happen at this point or whatever. So that is what we need to do. And in the meantime, what you can do is you can just do some other type of explorations. You can explore the websites, several websites. I can just name some of these websites which you can access. One is the Fitch Ratings website. Fitch Ratings. Now, the Sri Lankan website is, I don't know whether it is highly, it's not so much of rich with information, but you can have their international website, fitchratings.com. So that is, you can Google it and just get their website, Fitch Ratings, then you have S&P and Moody's. All these websites you can just go through and you could be familiar with all these things. And then you can learn several things on credit risk, and because they have some newsletters also. In those newsletters, you will get the ideas of certain economies in the world and how these economies behave, how the credit supply of those economies, how it is really taking place. So those things you can gather from the websites, that type of websites. Very important websites. S&P is a very good website. Not only that, even the Fitch ratings, Moody's, all websites are highly informative. Okay. Now I think on the next curve, actually this is a with high concentration because it has a value of 0.8182. Now just look at it. Now this is another way of looking at it. Now this particular distribution is illustrated on the basis of ratings. Now I think at a glance you might not get it that way, but what I want to tell you is the ratings are given here in numbers. Rating number 1, rating number 2, rating number 3, likewise it goes. Right? So therefore, now the particular chart is prepared with regard to two portfolios. One portfolio is represented in green. The other one is represented in yellow. And what this particular graph tries to demonstrate is now the rating number 1. What is the percentage of loans with rating number 1? What is the percentage of loans with rating number 2? What is the percentage of loans with rating number 3? What is the percentage of loans with rating number 4? Likewise, the particular distribution is made. Now, if you go to the green, represented in green, portfolio which is represented in green. So there you can see the grade 1 or the rating number 1, it is around 1% of the total portfolio. 1% of the portfolio represents the grade 1 or rating number 1. Rating number 2 represents about, say, 6% of loan portfolio. Rating number 3 represents about 12% of portfolio. Rating number 4 represents 40% of portfolio. So that is a high value. I mean, most of the loans are in rating number 4. Rating number 5 represents about 33% of portfolio. Rating number 6 represents about 4%. Rating number 7 represents about 3%. Rating number 8 represents about 1%. But 9, 10, 11, 12, no, nothing. Right? Now, if you just look at the portfolio which is represented in yellow, there you find the grading number 1 represents about, say, 2% or 2.5%. Grading number 2, 5%. Grading number 3, about 7% or 8%. Rating number 4, 10%. Rating number 5, about 11%. Rating number 6, about 14%. Rating number 7, about 10%. Rating number 8, about 9%. Rating number 9, about 8%. Rating number 10, about 7%. Rating number 11, about 6%. Rating number 12, about 5%. Rating number 13 is about, say, 3%. Rating number 14, it's about, say, 2%. 15, about 0.5%. 16 you can't see anything. Now you can understand which portfolio you can consider as a diversified portfolio. The yellow one, because it is being distributed evenly. Here you have now grade 6 is the highest number, but here the situation is very much different. It's a highly concentrated one here on rating basis, right? The yellow one is diversified, the green one is concentrated. Is that okay? Got something on that? This is only an illustration, right? Now that illustration is made by going through the rating of a loan. Now, rather, I think you are not very familiar with rating given by numbers. Ratings are normally given in English letters, no? AAA, AA, then you have BBB, BBB, CCC, CCC. Likewise, you get some, ratings are given in English letters. Now, of course, if you say rating number 1 is equivalent to AAA. Rating number 2 is equal to AA plus. Rating number 3 is equal to AA. Rating number 4 is equal to AA minus. Rating number 5 is equal to AA. AA minus. Then rating number 5 is equal to A plus. Rating number 6 is equal to A. Rating number 7 is equal to A minus. Rating number 8 is equal to BBB. So likewise, it goes like that. So that way also you can have a similar rating representation in English letters also. Is that okay? But the issue here is, now you all know, now we will discuss about these rating mechanisms also at a later stage. Now in most cases, in most of the banks, they have their own rating models. They rate their own loans, but those are not recognized in the international markets. But international markets recognize only the ratings given by the international rating agencies like Fitch Ratings, S&P, and Moody's. But in other countries, there are some other rating agencies which are locally operated, but sometimes those rating agencies are not recognized as international rating agencies. But in the world, there are 3 internationally recognized rating agencies, as I told you. Fitch Ratings is one, then S&P, that is Standard & Poor's, is the second one, then you have another one called Moody's. Now, when you do a portfolio management, yeah, you need to see some coding for loans, pin at the information attached to those loans, and not only financial information but non-financial information also. With that, with the help of a proper rating model, you would be in a position to rate the loans. Now, rating in the sense, some cases you put it as 1, 2, 3, 4 and all, but I think the better way is to put it in normal rating scales, AAA, AA, and so forth. If you can do that, and you need to see whether the things are being done correctly. Frequently, banks fail to gather appropriate data at loan origination and do not update data as needed throughout life of the loan. So that is the issue with most of the banks. because if you cannot collect appropriate information at the beginning, at the time of origination of the loan, it would be very difficult for the bank to gather information at a later stage. So before granting the loan, you need to collect all the information. But at a later stage, you need to update it by having a greater connection with your borrower. Reports of trades by borrower is rated on quarterly basis with graphical representation. Close review and monitoring of these reports may indicate whether your internal risk rating system is granular enough to provide meaningful data. So that is another, I think we are going to discuss about these rating mechanisms and all. I think in most of your banks, internal ratings been in use, I think. What about your banks? I think all of you have any rating mechanisms, in-house rating mechanisms? What do you say?
While appraising the papers, we have customer rating and in the credit appraisal.
You have rating models. You have in-house rating models.
Yes, sir.
Right, good. And then how do you really deal with such type of rating? Because do you have any reviews frequently, or say even annual reviews or whatever you have on these ratings?
Yes, sir. Along with the credit policy review, they will do this thing like
reviews, rating reviews.
Yes, reviews.
Right. So I think
and
the most important thing is the rating review, because then only you can see the migrations. Migrations in the sense, now basically when you grant an advance, the borrower is at a certain rating or is at a certain financial position. But in time to come, some of the borrowers, their financial position would be deteriorating. Some of the borrowers. So then, if you have a rating review only, you will be able to identify such borrowers. So then we can really construct migration matrices. So migration matrix is a particular matrix where you can see in which type of percentage the particular borrower has been degraded or migrated to a lower rating. So that's a very important point to note. So therefore, when you use a rating model in-house, it is very much important for you to see whether the rating module is really doing well, whether it is granular enough to provide meaningful data. And in the economy, there are some different things happening in the economy, or some trends being created. Then what could happen to these the ratings of those loans and whatever? So that type of things also to be taken into consideration. And that is why in most of the banks, the rating review is done only annually. But I think some of the banks, they now try to do it half yearly. I think that's the best way to do, because half year is a substantial, I mean, you can say it's an adequate time for you to do a review. You don't need to wait for 1 year, because 1 year can do several things. So therefore, if you want to do some early warning type of mechanism, that mechanism can be really developed through a rating review. So rating review to be done every half year. So if you do that, then you are in a position to just identify the borrowers with early warning signs. it should be granular enough to provide meaningful data, and if 40% or more of your portfolio is lumped into single risk category. So this is the dangerous thing. I don't know, in your banks also it happens like that. Now, whatever the rating you give, I mean, most of the loans are in one rating. So I think that's not a good thing. I mean, it might really represent, or it might really shows that your rating model doesn't work well. It is indicator that you are not getting best data from risk rating process. I mean, large concentrations in a single category may indicate that data being evaluated to determine borrower risk rating is not detailed enough to differentiate good grades from average grades. So that is the issue. Now, you have to be very careful when you select a rating model. I don't know, most of you have recognized institutions or recognized computer or recognized rating agency giving you a rating model, or it is developed in-house. Your one is developed inside. It is an in-house developed one, or you have purchased it from somewhere. Rating model. There are several vendors who sell these rating models. And this rating model should be applied consistently throughout the organization. Segmenting risk rating reports into geographical regions or even branches will help in knowing this. Effective as early warning system. Right, now this is about the migration analysis. Right, we can have a small break, and I will start the lessons again 10:50. Right. In the meantime, you can just look at this migration analysis model and you can have even tea. Anyway, I will come back by 10:50. Now this migration analysis is a very important one, so we will see how we can use it. It's a method to measure loan concentration risk by tracking credit ratings of firms in particular sector or rating class for unusual declines. Credit managers track credit ratings, their own or ratings done by rating agencies of certain pools of loans or certain sectors. Tracking reveals faster decline. Now the declines can be checked or can be detected in rating migrations. Now, if you find some of the loan categories, so some portfolios, the ratings being migrated to adverse type of rating classes, and if it is faster than earlier, then it's a thing to be looked at. Then the bank has to take certain decisions whether to continue with such lending or abandon that type of lending. Right, now you can just see. Now this is an example of a large commercial bank's composition of loans in different rating class. Here the rating classes are given in English letters: triple A's, double A's, A, then triple B, double B, then B, C, and high risk, and that type of things. High risk in the sense P and C. Low risk is triple B, double B. These are the good ratings. I mean, low risk means no risk like here. Now, it has been given in two different ways. One is amount-wise composition, loan values. Then account-wise in the sense number of loans wise. You can see amount-wise composition. There's only 2.4% of loans coming into the category of in amount triple A's. Now you can see about 32.4%, that is the highest percentage, is in triple B. Right now, can you just look at this and get some idea? Now here, I will just give some explanation on these ratings. Now up to triple B, we call it the investment grade, triple B plus or triple B. Below that, we call it speculative. Now after B, we call it junk. I will show that on the board with the different risk ratings or different credit ratings and the things or the way it is being classified in the normal rating by rating agencies. Now, this is the way the ratings are normally done. AAA, AA plus, AA minus, A plus, A minus, triple V, double B plus, double B, then double B minus, then B plus, B and B minus. Then you have triple C and double C. Now afterwards you have to have default. Now up to triple B we call it investment grade. Triple A is the best grading or best rating, and out of that now in the investment grade the last level is triple B. Then you have the speculative grade up to B plus or double B minus. Beyond that you have the speculative grade. Now there's a small exercise you need to do here. Now under these numbers you get weighted rating of the portfolio, that is triple B. Now one has to get some idea about the weighted rating of this portfolio, because the portfolio has loans of AAA, AA, triple B, double B, B and C. Now all these ratings are in this portfolio, and one have to just look at and just get an idea about what is the weighted rating of the portfolio. How are we going to get into that? How are you going to arrive at that weighted rating in the portfolio? You have to just suggest a method to arrive at the portfolio rating, weighted rating of the portfolio. You can just tell me the methodology. The answer is given here. Weighted rating is, they say it is triple B. Answer is given. But how you have arrived at that answer?
We can give a number for the credit rating, and then take the weights as percentage of composition, and then multiply both, and add.
Right, good. Right, that is the way. So what you need to do is, you need to multiply the rating. Now AAA rating is equivalent to number 1, AA is equal to number 2. Likewise you have the ratings, and it can be mapped to the numbers. So then what you need to do is 1 into 2.4 plus 2 into 14, 3 into 26.3, 4 into 32.4, 5 into 14, and 6 into 7.3, 7 into 3.6 divided by 100. Then you will get the value. So just look at and just do the calculation and see whether it comes as 3.78. Yes. So what is the answer you get by doing that? Yes. What is the answer you get? No, it is given
3.77.
3.779, no?
Yeah.
3.779. Yes, yes. So that is correct. So then now can't we take the composition also in account wise? That is also a possibility, but you just look at and see whether same answer is coming there. There can be some difference, but there may not be the rating may not be different. I think you just look at that and see. Account wise thing also you can take into consideration. And we can compare the both sides.
It's different, sir. It's 4.05.
Yeah. 0.5. Yes. 4.05. But anyway, it doesn't make any difference in the rating grade, no? The rating now, even when you get 3.78 also we put it as triple B, because triple B, the correct rating is 4. 3.78 is very close to 4, so therefore we took it as triple B. And here also, if you go by the 4.0405 type of thing, that is also coming into the triple B. So therefore, there's no big difference in the rating grade by using the composition account wise also. That's okay. But you don't get the same answer in account wise composition, because that is understood. No, that really happens because this particular portfolio, now you can just compare and see. Now you can do a Lorenz curve also for this and see what is the now 2.7, that is 0.7% of accounts represent 2.4% of value. 4.4% represent 14%. No, likewise you have now. Otherwise, you can just do another thing. You can do a cumulative thing also this time. So that is another way of doing it. But anyway, the weighted rating can be calculated by going through either the amount-wise composition and account-wise composition. Both things are correct, but you don't get the same answer. But the answer doesn't have a big difference. Now, here we talk in terms of a cumulative default rate. Cumulative means it is been added up. Now, here you have risk ratings, annual average default rate, and the cumulative default rate for 3 years. Now, the meaning of that is cumulative default rate for 3 years means for 3 years they add it up. That is what you mean by cumulative. Now you go by risk rating, number AAA, annual average default rate is 0. Cumulative default rate is also 0. Then for AA's, annual average default rate is 0. They are also cumulative default rate is 0. But in rating grade 3, there is A, annual average default rate is 0.31. Cumulative default rate is 0. in triple B, annual average default is 0.84 and cumulative default rate is 2.77. Double B 1.66 and 3.69. Now you can see the risk category and default rate, there's a curve. The risk category is, now you can put it as 1, 2, 3, 4 and so forth, and default rate as 0.31, 0.84, likewise you can have it. If it is a cumulative default rate, the particular curve will be different. Now you can see here, these cumulative rates are not really the 3 times of this, but it is average to 3 times, but it is not 3 times. It is less than 3 times most of the time. But in this case, only it is little higher than the 3 times. But here it is lower than 3 times. Here also. But here you have it is higher than 3 times. So can you get any idea when I say cumulative default rate? What is the meaning? What is the meaning of cumulative default rate? Now what you do is annual average rate is there, annual average default rate. Now if it is for the first year, you have a value. Second year also you will get a value for that. And third year also you will get a value. All these values to be added up, and that will give you the cumulative default rate for 3 years. Then we go into the very important point of average transaction metrics. Now just look at it. And this is a very important point, and I think in your organizations also, if you can prepare a transaction metrics like this by doing a rating review, and that would help you a lot. So I think if you have not done it up to now, you will be in a position to do that. I think you can we can go to the average transaction rate metrics. Now I can just explain it this way. Rating from 2. Now you can just look at the vertical column here. That is AAA, AA, 1, 2, 3, 4, 5, 6, 7. AAA, AA, triple B, double B, B and C. Now if you take the horizontal line, yeah, you have AAA, the same things are given, and there you give the default also. So what will happen here is you start with 100 loans of AAA in the first year. So when you wait for the second year, you can see that out of that 100 loans, only 76.47 loans remain in the AAA. I think you need to look at it and get that idea correctly into your mind. 76.47 loans of 100 of, if you take 100 loans at the beginning, and after 1 year, only 76.47 retains in the AAA category. 17.65 has migrated to AA. 0 migrated to A. 5.9 migrated to triple B. That's all the migrations. So if you take the total of that, that would be equal to 100. So you can just look at it and see whether it is equal to 100. That should be 100. 76.47 plus 17.65 plus 5.9. Yes. Now with the rounding off, you would get 100.02, but it should be 100. Right. Now, if you go to the second line, the second row, there you get double A. But if you have double A, 100 double A's in the first year, but if you look at it in the second year, what will happen is you have only 50 of that double A things we had earlier in the double A category. Out of that 100, 4.7 being transferred to triple A. That's a favorable migration. But in triple A types, you don't get any favorable migrations because triple A is the highest grade. But if you have double A, 100 in the first year, retains in the double A only 50%. But out of that, another 4.7 has gone to the very favorable sector. So that is a possibility. But 29.7 transferred to double A. That's a adverse sector than double A. To triple B, 14.1 transferred. To double B, 1.6 transferred. Now, if you take the total, there also you should get 100. If you go to the third line, yeah, out of 100, 57.2 remain in the A category. 8.7 went to the double A category, that is a favorable grade. 0.4 transferred to triple A category, that's a very favorable grade. But out of this 100, 25.8 transferred to triple B, 7.1 transferred to double B, 0.4 transferred to B, and even from that 0.3 transferred to default also. So that means not like in triple A and double A has a default also, 0.3 of default. When you go to triple B, there's no transfers to triple A. 65.7 remains in triple B. 16.8 transferred to A, that is a favorable sector. 1.5, that is double A, that is also a favorable sector. 11.6 transferred to double B. 2.7 transferred to B. 1 transfer to C. And 0.8 transfer to default. Now you can see when you compare it with A, the default rate of A, triple B's default rate is higher than the default rate of A. Then when you go into double B, no transfers to double A and triple A, but there's 3.9 of transfers to go to A. 31.8 went into triple B, that's a favorable transfer. 49.7 remains in the same category. 11 went into B, 2 went into C, and 1.7 defaults are there. All are given in percentages, right? And when we go to B, now out of that 100, 46.1 only remain in the double B. 28.6 went into double B, that's a favorable sector. 5.2 into triple B, that is also a favorable sector. 1.3 into A, that is another favorable sector. 12.3 went into C, and 6.5 went into default. If you go into C, there are 63.1 remains in the same category. 19.4 went into B, 3.2 went into double B, and 14.3 defaulted. Now, from an average transition rate matrix, you will be able to find out the default rate of different rating categories. Now, as per this average transition matrix, you will see that triple A, the default rate is 0. Double A also default rate is 0. A, default rate is 0.3%. Triple B, the default rate is 0.8%. Double B, the default rate is 1.87%. B, the default rate is 6.5%. C, the default rate is 14.3%. So you can see how the default rates are increasing when you go along the rating from higher rating to lower. Right now, that's the lesson we learned from transition matrix. I think in your organizations, if you have a rating model, it is very much important for you to prepare the average transition matrix for your loans after doing a rating review. Now, those rating reviews can be arranged for each half year or each annual terms, or if you want, you can put it for quarterly basis also. If you find that your loans are very volatile and they change their positions very frequently, if that is the case, you need to do a rating review for every quarter. But I think that may not be practical, because when you complete one rating migration or one rating review, you will spend the whole quarter. So therefore, the possibility is to have a half-yearly review, because these half-yearly reviews will give you so much of time or so much of early warning signals for your loans, loan portfolios. Right. Now, if I ask this question, tell me. Right. Now, have you got my question? Now, my question is, what is the percentage of loans transferred out from the investment grade in the A category? In the A category. What is the percentage of loans transferred out from the investment grade in the A category? Simple question. Yes, simple question.
%43%.
Transferred out from the investment category. Now, investment triple B is also included in investment category, so therefore it is only 7.1 plus 0.4 plus 0.3. That is 7.8. Because triple B is also taken as investment category. So investment category means up to triple B. So therefore, if I have asked the question, transferred out from the investment category means double B, B and C, and then the default is also there. So therefore, altogether it is 7.1 plus 0.4 plus 0.3. Now, if you look at this, if you go through the diagonal, now the diagonal shows the retaining things in the same category even after 1 year. Now you can see now up to triple B, the retention is a little higher, but again that retention became higher in C. Double B and B, the retentions are not that high, but anyway, this the defaults been started with A. But if you go to a separate another type of a rating matrix, there can be differences in these migrations. But this is the particular migration where we have gone through on account of a certain company, certain bank or whatever. Now I think today we discuss about concentration risk, Herfindel index and the Gini coefficient. So those things can be used in portfolio level managements. Not only that, in sometimes you need to put forward your ideas in the credit committee and some other type of meetings. There you can make use of these things in your day-to-day affairs. And the most important thing here is that if you have a rating model in your bank, you have to be careful about that rating model and whether that rating model is validated, and it is given valid type of ratings. That is what you need to be very much clear about. Now again we try to see the distribution of these ratings in a certain in two portfolios. In one portfolio it is we regarded it as a concentrated portfolio, and the other portfolio is a rather satisfactorily diversified. So you can just see the particular distribution. If you just connect the dots of these the top lines of these top levels of these pillars, then you will get a curve like this, or yellow type of pillars. But this green type of pillars, you will get a distribution, very sharp type of distribution, and the top is very high. So that we call a concentrated type of portfolio. And you have very high percentage of loans in one loan category, two loan categories. Now, if you take rating grade 4 and 5, it will be 40 plus 30, 32 or 33. There is 73% of loans are in these two categories only. So that is the concentration. So anyway, now these are the issues which we need to face in using the rating models. Right. Now, when a rating model is used, you have to be careful, because you need to have a certain financial and non-financial information with regard to your loans to arrive at the rating grade. And after getting the rating grade, you need to validate that grade. In order to validate, you need to do some rating reviews in a higher frequency at the beginning. So then later on, after doing several reviews or 2 or 3 reviews, you can have a stable type of a rating model where you can rely on. Right, now we will go into another area where we try to just look at the introduction to portfolio models. Now in the portfolio setting, we have to consider 2 types of losses. And one category is called expected losses. And the other category is called unexpected losses. Now if you take the portfolio, you have, say, you have 10 loans in the portfolio. For simplicity, we just assume like that. you have 10 loans in a portfolio, for each loan, you can calculate the expected loss. Now, I think you remember what I mean. Expected loss is calculated by multiplying the probability of default into expected, probability of default or the expected default frequency into exposure at default, and it is to be multiplied with loss given default. And with that, you will get the expected loss. Now, if you want to get the expected loss of the portfolio, you can really get the total of expected losses of each loan. And that total can be taken as the portfolio expected loss. But when calculating the portfolio unexpected loss, it is significantly less than the sum of individual unexpected losses due to diversification effects. Now, I think this is a very important point to note. If you talk in terms of a portfolio, you all know that the portfolio consists of individual loans. All these individual loans, we can arrive at expected loss of each loan. Now, say you have 10 loans in the portfolio, then expected loss of loan number 1 is there, expected loss of loan number 2 is there. So we can say EL1, EL2, expected loss 1, expected loss of loan number 2, EL2, up to EL10. Now, what is the total expected loss of the portfolio? EL1 plus EL2 plus EL3 plus ... ELN or EL10. So that would be the total expected loss of the portfolio. But we have to consider another type of a loss, and we call it the unexpected loss. Now, when you calculate unexpected loss of each loan, there are ways and means of calculating unexpected loss of each loan. But you can't get the portfolio's unexpected loss by adding up all the unexpected losses in the portfolio. All the loans, unexpected loss of all the loans in the portfolio adding will not give the total unexpected loss for the portfolio. The reason is given here is because there are correlations between the loans of the portfolio. There are several loans now, so for each loan there will be correlations. With these correlations and individual diversification effects, the total of unexpected losses will not be equal to the total unexpected loss of a portfolio. So the correlation is a very important factor in computing unexpected losses. EL is the expected loss, UL is the unexpected loss. EL and UL are basically functions of the same parameters with additional second order terms in the UL expression. Now, since the things are little complicated, I will explain it on the board. Now, up to now, are you okay with this? Up to now, are you okay with this? Yes, what do you say? Now I start explaining the calculation of portfolio loss or portfolio risk. There you have two categories. One category is expected loss of the portfolio. That is not a difficult task. if you can calculate the expected loss of each loan, the total of the expected loss of each loan will give you the portfolio expected loss. But it is not adequate for us to just calculate only the expected loss. We need to calculate the unexpected loss also. In the calculation of unexpected loss, there can be several two second order statements, and if you calculate unexpected loss of each loan, adding up all the unexpected losses will not give you the total unexpected loss of the portfolio. So that is an issue. Now we have to see how we can sort it out, because in order to calculate in order to get some idea about the portfolio, you need to calculate not only the expected loss of the portfolio, but the unexpected loss also. Therefore, we need to see the ways and means of arriving at unexpected loss of the portfolio. මේක තව ලොකු කරන්න ඕනේ නේද? මේක. Right. Now expected loss and unexpected loss to be calculated. But you need to understand that in order to get the expected loss of a portfolio calculated, what you can do is you can just get the individual loans expected losses and get the total of it. That will give you the expected loss of a portfolio. But when you go into the calculation of unexpected loss, the calculation is little complicated than calculating the expected loss. And at the same time, you will not get the total portfolio unexpected loss by adding up the unexpected loss of each loan. So the reason for that is there will be correlations between the loans in the portfolio. And if you go deep into these things, EL and UL are basically functions of the same parameters with additional second order terms. Now, what do you mean by that? I will show it to you this way. Now say expected and unexpected loss, you can have a graph. Now EDF is the probability of default or the expected default frequency, and percentage loss per unit of average exposure. That is the percentage loss. Now when it is expected loss, it is a linear relationship with the expected loss. In other words, when the probability of default increases, expected loss also will increase proportionately. But when you talk in terms of unexpected loss, what will happen? Default frequency or the probability of default increases, unexpected loss increasing in an exponential manner. You can just look at the graph and see. Are you comfortable with that? Because now we are learning the behavior of expected loss and the unexpected loss. Not only the behavior, the characteristics of expected loss and the unexpected loss. Now, one characteristic of expected loss is it is a linear function of EDF, that is expected default frequency or the probability of default. In other words, when probability of default increases, expected loss also will increase in a proportionate manner. But if you look at the unexpected loss, when the EDF or the probability of default increases by a certain amount, unexpected loss will increase by an exponential amount, very large amount. So you can see the graph and get an idea about that. Now, this is a very important chart you can go through, and you can get a picture of the behavior of these things. Recovery rate is one, credit quality and the EDF. Now, this credit quality is a very important or very critical type of measure. EDF is the expected default frequency. Sometimes we put it as probability of default. Now, when you say increase in factor, recovery rate. Now, these are the factors we have taken into consideration. One factor is recovery rate. The other factor is credit quality. Then the expected default frequency. These are the three factors we have taken into consideration. Now, when recovery rate increases, what will happen to expected loss? It will decrease. Unexpected loss, that also will decrease. When credit quality is increased or credit quality is becoming better, expected loss will decrease. Unexpected loss also will decrease. When expected default frequency or the PD, probability of default increases, expected loss will increase. Unexpected loss also will increase. Now, this will give you a simple demonstration of behavior of recovery rates or the relationship of recovery rate, credit quality and expected default frequency into expected loss and the unexpected loss. Now look at it. This is a symbolic expression of portfolio expected loss. It is given as ELP. It is the sigma of ELI. ELI means the expected loss of ith loan. Adjusted exposure into LGD into EDF. AEI means AE1 or 2 or 3 or whatever. Now the unexpected loss is calculated in this way. Now the calculation of the portfolio unexpected loss is more complicated from the cost terms in the variance formula for N-asset portfolio. Now you look at it this way. Now what do you mean by UL1? UL1 is the unexpected loss of loan number 1. UL2 is the unexpected loss of loan number 2. Assuming that there are only 2 loans in the portfolio, you can arrive at these figures. Then and you can just look at it and see how we calculate UL1 or the unexpected loss. That is AE1, that is expected adjusted exposure for asset A, asset 1, into the square root of EDF. EDF1 means the loan number 1, default frequency, into sigma squared LGD1 plus LGD1 squared into sigma squared EDF1. Now, the things being explained here, AE1 is the adjusted exposure of asset 1. EDF1 is the unexpected default frequency of asset 1. LGD1 is the loss given default of asset 1. Sigma is the standard deviation. Now, then we look at the diversifiable and undiversifiable risk. An asset held in isolation bears both diversifiable and undiversifiable risk. In a portfolio context, the diversifiable risk is reduced effectively to 0. On the other hand, undiversifiable risk is the residual rate risk or the risk contribution that cannot be diversified away. And sometimes we call it the market risk also, or systematic risk. The effect of correlation. Correlation between bank assets is critical to measuring the potential portfolio loss. And if the correlation between assets increasing for a bank, and it will suffer from concentration risk. Now, actually, the concentration or the correlation is what default on one asset spills over to other assets, exacerbating the problem. It is therefore important to have reliable estimates of default correlations. Now, actually, the correlation really comes with the default. Now, we call it a default correlation, because if one loan defaults, it will spill over to other loans, and or other loans also will default. There are limitations in the measure of correlation and dependence of among defaults. When defaults are not normally distributed, a zero correlation does not imply defaults are independent. Because defaults can have some connection. Correlation is not a good measure of dependence when the underlying variables have distributions that are with infinite variance. To overcome the above issue, a function called copula is defined, which joins a multivariate distribution function to a collection of univariate. Now, I think these things are not that necessary for you, but this is only an explanation. Now, in our calculation of unexpected losses in a portfolio, you need to apply a certain formulas and certain type of mathematical things. But the reason for that is given here, but that is not that important for you. But anyway, you need to understand that the normal correlation calculations will not really help in this type of calculation. That is why it has been mentioned here. Therefore, a particular function called copula is defined, which joins a multivariate distribution function to a collection of univariate marginal distribution function. And we will do some examples, and then you will get it more understood. Right, now there are some method, and that method is called Gaussian copula model. unexpected loss of a portfolio can be estimated by quantifying the unexpected loss of each asset and arriving at the joint probability distribution. Let the unexpected loss of ith asset of the portfolio is given by following relationship. UI is equal to AIF plus 1 minus AI squared ZI, where AI is the correlation between two assets, F is the common systematic risk factor, ZI is the idiosyncratic factor for ith asset. Now this is a formula which we can use, and in order to give you a certain type of a release or type of a consolation, what I do is I will give some formulas in your examination. You don't need to memorize these formulas, but there are some formulas which are obviously taken as people know those formulas. So therefore, those formulas are not will not be given in the question paper, but all other formulas will be given in the question paper when it is necessary. Now just look at this formula. Now it shows the way in which the unexpected loss is calculated of a particular asset. And there's a model called, but before going into these things, we will do some examples on earlier type of calculations. Right. Just look at this. Right, I will just explain these things on the board. Right. Now, if you assume there are n loans in a portfolio, and the expected loss of one loan number one is, we take it as EL1. And since you have n loans in the portfolio, the total portfolio risk is equal to EL1 plus EL2 plus EL3 dot up to ELN. So that will be the portfolio expected loss. And you all know how to calculate the EL1. So I will put it that way. EL1 is equal to average exposure of loan number one into LGD1 into EDF1. Now this order can be changed, no issue, whatever it is. AE1, that is average exposure of the loan number one, loss given default of the loan number one, and expected default frequency of the PD, probability of default of the loan number one. Now, when you want to get the EL2, that is equal to AE2 LGD2 into EDF2. Likewise, you can calculate all the expected losses of all the loans, and that has to be added up, and that will give you the portfolio expected loss. Portfolio expected loss. But this is very simple for the calculation of expected loss. But if it is for the unexpected loss, it would be little complicated. Calculation of unexpected loss is little complicated than the calculation of expected loss. That you should understand. Now I can show you the calculation of unexpected loss. Right, you can just look at the formula there. UL1 is equal to AE1 into square root of EDF1 and sigma squared of LGD1. You need to calculate the variance of loss given default. Then LGD1 squared into variance of expected default frequency. Now those things also to be taken into consideration. And that is not as easy as simple as calculating the expected loss. Now you look at the explanation of these symbols. So AE1 is the adjusted exposure of asset 1. EDF1 is the expected default frequency of asset 1. LGD1 is the loss given default of asset 1. Sigma is the standard deviation. Right. Now there's another thing here I want to just explain to you. Now the upper one, that is ULP. ULP is the portfolio unexpected loss. And this explanation is given in terms of only two assets. We assume that for the simplicity, we assume that in the portfolio there are only two assets. Those assets are L1 and L2. And what do you mean by UL1? That is the unexpected loss of loan number 1. What is the meaning of UL2? That is the unexpected loss of the loan number 2. And row 1, 2 is the correlation between asset 1 and asset 2. Now you just look at the unexpected loss of the portfolio, and that is given by the square root of UL1 squared plus UL2 squared plus 2 row 1 to UL1 into UL2. Yes, anything you need to clarify? Yes. Anything need to clarify? Yes. Yes, tell me anything. I mean, if you want to just clarify anything, I can do that. Yeah. Yes. Now I want to just explain these things in a simple way, but that is why I just want to put it on the board. Now, if I put it in these terms, initially we would expect or we would assume that there are only 2 loans in the portfolio. That is the most simple type. So there are unexpected losses as UL1 and UL2. And the correlation between UL1 and UL2 as rho 1, 2 correlation coefficient. Right? So now, and assume portfolio unexpected loss as ULP. So then ULP is equal to square root of UL1 squared plus UL2 squared plus 2 rho 1 2 UL1 into UL2. So this is the formula. Now this is given in the presentation also, but what I want you to see now, you can just look at this and get a better understanding by looking at it. Right. Anything you need to clarify on this? Because this is a little complicated thing, but I will try my best to put it in a simpler form. Now, basically, when you do the portfolio calculations, you have to be careful about the type of loss we are going to calculate. It can be either expected loss or the unexpected loss. But if you calculate the expected loss, it's a linear type of a thing. There you can just add in up and get the total portfolio risk, portfolio expected risk or the loss. But if you go in to calculate the unexpected loss, it would be little complicated, because first of all, the calculation is also complicated, because unexpected loss is calculated in a different formula. It's some second order terms. I have given the formula there. But at the same time, you are not in a position to get the portfolio unexpected loss by adding up all the losses. There will be another formula for the total portfolio loss, unexpected loss. That is given here. That is given on the board even, and in the presentation is also there. Right. Now, up to now, you have any type of confusion, or you need to clarify anything? Do you need to clarify anything? Today only 1 or 2 persons talk, no? Uresha, why didn't you talk?
No, sir, I followed the lecture. So if there's a possibility, can you send some model questions and answers where we can individually practice?
Yes, of course. But I don't think that, no, it is like this. I don't give you the answers, but
Okay.
only thing is I can give you some questions and I can give some guidance.
All right, it's okay. So only
Because,
just the final answer is there. We thought that
of course.
we can.
Now I think you are correct. But what I feel is, now if I give the answers, then the particular the spirit will not be there. So
Okay.
therefore, what I do is I just give you the guidance. The guidance is some hints I can give. Then you can really think in those lines, and you can do the needful. And at the same time, if you have any issues with regard to your work environments, your normal day-to-day activities, you can raise issues here, raise questions here. Then we will be in a position to discuss those things. That will be more important, I think.
Thank you, sir.
Now, today's lecture basically dealt with portfolios, and I think that would be the more important thing for a bank or a finance company or whatever, because your concern is on the portfolio credit quality. So that credit quality you have to maintain, and if you don't maintain your credit quality, that will be very drastically impact your organization. So therefore, it is very important for you to maintain the quality of the portfolio, credit quality of the portfolio. So in order to do that, you should know all these things, and don't worry about these calculations, because if you can understand the principles of these things, it is enough. You don't need to be worried about the calculations, the formulas and all that, because all these formulas will be given in the question paper if you want. But if you do not know the principles, even though you have the formula, you can't do anything. That is the issue. So therefore, you should be careful to get the particular principles understood. Right. I think today we don't have much to discuss, and its time is now coming very close to 12:30. And do you have any issues to discuss, or anything to discuss? And today, I think there's another one who talked with me at the beginning with regard to the concentration risk and all. And you all should have some words, I mean, some type of a discussion. That is very much important, because all others will get benefited from that. Then Jayasanka and all these people, I think even once in a way, you all should talk once in a way. Because I am very much appreciating all of you to get into the discussion level, get into the clarification level. Then I think, and the other thing, but I want to tell you is, you have more opportunities or more avenues open for your higher studies. If someone wants to do that, I can give the guidance. Either you can follow Chartered Financial Analyst, that is CFA, or the other one is Financial Risk Manager, that is FRM. Both exams are equally recognized, equally popular in the world as international qualifications. Now I think we are really in a very critical and very challenging position as Sri Lankans. You need to look at how you can draw some foreign currencies to the country. If you can build up your competencies, you can sell yourself to other countries. By that, you will be in a position to draw foreign currencies to the country. Which means that if you can go to another country and get some employment there, and I think if you become an investment analyst or a risk manager or whatever, you can draw a high salary from another country. That will benefit the country also, our country also. So these are the things which we need to just think about. So you all should think about it. I just advise all of you to be critical and be vigilant on those things. And if you need any help, I will be in a position to do that for your higher studies. Because it is not just for studying to get some greener pastures in other countries. Even just in American and European continents, you will just get all these things. So be vigilant on those things. And of course, this particular course, and it is very much enriched with necessary subject areas, and it can be taken as a stepping stone to this Chartered Financial Analyst or FRM examination. So with that, I wind up today's session. Thank you very much for your live participation. And I will expect from you, from the next time onwards, more engaging and more interactive participation. Thank you very much.